While it may seem like a daunting time to invest in property, did you know that there's ways to invest in commercial real estate without spending millions? The answer is real estate investment trusts, often referred to as REITs. These are publicly traded companies that operate and finance properties and then benefit from the income generated. Primaris is a REIT with properties across Canada with a primary focus on shopping malls. This company is a spin-off from the H&R REIT and has successfully expanded their asset base since 2003.
So there are several reasons why we would say that Primaris has performed relatively well. The first being that when it was spun off from H&R REIT last year, it was spun off at a relatively attractive valuation. So they were not expensive relative to any metric that we would look at in valuing the REIT. As well, the expectations and the guidance from management when they initially, when it became a separate REIT, were relatively conservative, and the REIT has exceeded expectations, analyst expectations, investors' expectations since that time. So that definitely led to greater cash flow growth forecasts. And as well, some of the reasons why REITs and real estate has performed poorly this year, the impact of rising interest rates has been less of a factor for Primaris REIT, as it has lower leverage and a stronger balance sheet than many of its peers.
Overall, what is your take on REITs for investors that are looking to diversify their portfolios?
So when you look at REITs, there are a bunch of different asset classes that we would call the main areas to focus on. That would be office, apartments, retail, and industrial. Over the past couple of years, the industrial sector has been the strongest with the growth in e-commerce, and that's come at the expense of retail to some extent. Rental apartments have also been quite strong with a shortage of affordable housing in Canada. We think that owning some industrial REITs and apartment REITs are definitely easy ways to play those themes.
In reviewing their recent financials, are there any key indicators that you would note to our audience in reference to their future growth?
As far as going forward, we do believe that they can achieve some further occupancy gains, and they are likely to be very active in buying back stock. However, the positive impact of this on their cash flow should be largely offset, at least in the near term, by our expectations of a softer economic outlook, as well as the fact that they're going to have to refinance some mortgages with interest rates having risen, and therefore there's going to be a negative impact on cash flow from that.
Canaccord Genuity analysts currently have a buy rating on this stock. Thank you for joining us today, Mark. Like and subscribe to keep up to date with the cash management team and the latest Canaccord research.